Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. This is Quincy Krosby. This is Monday morning, April 24th. It is The Talking Point. Thank you for joining me. Before we launch into this week's important indicators for the economy and the markets, let's just finish up with last week. First of all, in terms of the sectors that led last week, actually it was on the defensive side. You saw utilities climbing higher. You saw consumer staples, but it wasn't by much. Remember, the market right now is in a fairly tight trading range, and it is in what I would call a wait and see mode. In other words, try to absorb all of the data, try to absorb what the companies are saying, and perhaps as we get through the important weeks in the earnings season, and certainly this week is one, see how the market basically is oriented. We have seen a basic seesaw trade. 1 week, one day, we may have the cyclicals climbing higher, tech, semiconductors, consumer discretionary. And then, we'll swing to the other side as the market becomes more worried about growth, because what happens then is you see the yields start to come down in the treasury market. And that suggests that, the economy is slowing. Inflation eases when the economy slows, and slows dramatically. But again, it has been the seesaw. So I wouldn't say that the market is wedded to consumer staples or wedded to the consumer cyclicals. It is basically a market that, again, to repeat, is in a tight trading range. Now, I do want to add, I mentioned last week on Monday's call, the importance of the Philadelphia Federal Reserve Bank's report on manufacturing. And I talked about the Empire survey, which is the New York State. We saw an uptick, which was really interesting because it had been down so much. But we saw it in terms of new orders, especially. Philadelphia Fed survey, manufacturing survey. By the way, there are 5 of these around the country, and that from the various Federal Reserve banks in terms of manufacturing. But the Philadelphia Fed survey is seen as a leading indicator in terms of the economy, in terms of where the rest of the manufacturing reports are going to come out. It has a closer relationship with the heartland in terms of manufacturing. We'll see if that holds, but I just want to point out it wasn't good, right? It was not good. And it showed again that manufacturing is down in the country. So either that's the outlier and the Empire Fed is the one showing us where we're headed in a positive way. We don't know, but normally Philadelphia Fed survey is considered to be extremely important in where we are headed in overall manufacturing in our country. So when we look at where the economy is, oddly enough, because you see the headlines, a recession, a recession, a recession. Well, this week, we're going to have a report on GDP. But I do want to say I do tend to look at the Atlanta Fed now, GDP now. I have to do this asterisk. It doesn't represent necessarily the views of the Atlanta Fed itself, but it is an ongoing. It absorbs all of the data releases that come out, and it revolves. It's a dynamic to where GDP is. And right now, as I do this call, they have Q1, the first quarter GDP at 2.5%. Now, that is as of today. On April 26th, however, there will be an upgrade, and there'll be an awful lot of data coming out that will go into the April 26th GDP Now report. So again, we're in the second quarter. We realize that, but the market wants to see, did we go into negative territory already in the first quarter? So it'll be interesting to see what the official one is when it comes out this week. This week, as everyone knows, is important. So in terms of earnings, the earnings season has not by any means been a disaster. You could argue that, the bar was set very low, therefore it didn't take very much to beat it. But nonetheless, it has been, it has been okay. I wouldn't get carried away and say it was stellar, but it wasn't dire either. Procter & Gamble, for example, had very good report last week on the top line, bottom line in terms of full year guidance. Today, we had Coca-Cola. It's, as I do this call, it's still up in the futures market, but it came out, we raised prices, but people are still buying. Procter & Gamble, the same thing, which is interesting because the expectations have been that consumers in the U.S. at least were going to move to the off brands in terms of the kinds of products that we see from Procter & Gamble. Not so fast. They raised their prices and consumers were still buying. Coca-Cola raised their prices and consumers were still buying. Now, in this week's reports, what we are going to look at this week is important reports coming out. Most of all, we're going to get on Friday the Personal Consumption Expenditures Index. That's the PCE report, which is the Federal Reserve's preferred view of inflation. And obviously that's going to be extremely important, and it's on Friday, because that is what the focus is. Are we through with the heavy dose of inflation? Is the sticky inflation still sticking? And that's what the market wants to know. We are seeing, for example, from the small business owners surveys, they are saying that they're not being forced to hike wages that dramatically the way they were in order to keep workers. They are saying, however, they're seeing, stresses in terms of securing new loans, that there are obstacles towards new loans. That's not something that we want to see across the board. Absolutely not. But nonetheless, the economy has been holding up. And in terms of inflation, however, there are still the concerns over what they call the sticky inflation. Now, I do want to point out that rents are coming down. It is a lagging indicator. And once it starts to show up in the Consumer Price Index and the PCE, it's going to help, I think, move our attention to an inflation story that is, albeit slowly, coming down. Now, there are concerns. I do have to say this, and I know that everyone says, well, Quincy, the Fed doesn't look at, food and energy. Well, I've always said this. We do, right? Every one of us does. I have noticed that food prices are inching higher, not lower. Yeah, egg prices are down dramatically, but a lot of the vegetable prices, a lot of the prices for fruit are edging higher. I do my own survey. I go shopping and I look to see, this is odd. Why is that happening? Well, we are seeing, in terms of commodities, take a look, and you will see that it has inched higher in terms of the food-related commodities. Now, the other thing we're looking at this week is, not today so much, we're not having any major reports coming out today, but Tuesday we will have home-related, housing-related reports coming out. New home sales, the S&P Schiller Home Price Index. And by the way, we've seen home prices across the country overall, not everywhere, but coming down about 3%. Still, there are pockets of the country in which housing prices are going up. There are bidding wars still. The reason is anywhere where you still have a strong economy, strong labor market, people are spending despite the higher mortgage rates. On Tuesday, tomorrow, we'll have new home sales, we'll have consumer confidence, and then on Wednesday, we will have the GDP report that I mentioned. It's not the Atlanta Fed GDP Now report. No, it is the government's report. And we will have pending home sales. But the one that I'm going to be looking at on Wednesday is the durable goods report. Now, normally, everyone thinks of durable goods as refrigerators, washing machines. But embedded in the durable goods report is core durable goods. This is the look at capital expenditures. What are companies spending? What are they buying? Is it up or is it down? It has been trending lower. So we want to watch that and see whether or not companies have increased their CapEx, capital expenditures budgeting, or is it still down? That gives us a story about what are companies seeing in terms of their actual allocations. And then on Thursday, we'll always look at the initial unemployment claims, and they have been climbing. Yes, they have been climbing. Is that good news? Is it bad news? It depends on what our perspective is. Our perspective is right now on wages, because we want wages to come down. And why do we want wages to come down? It does sound awful, but the key here is if companies are raising wages, they try to raise their prices, and that is inflationary. So if wages are coming down or leveling off, it means that companies, right, are not so quick, we hope, to raise their prices, because they do understand that the consumers and businesses are not as keen to cave anymore into those higher prices. Yes, we heard from Procter & Gamble, Coca-Cola, but not when it is, every single thing that we do. We're starting to see that consumers are being more careful. But when we see the initial unemployment claims coming down, it's an indication that the labor market is leveling off. It's still strong, but it is leveling off in terms of wages. Now, the other thing that we will be looking at is the employment cost index. This is important because it gives us an overview of employment costs. Where are they headed? You don't want to see them headed higher now. When we're coming out of a recession, we look the other way. We look to see, are we starting to see a pickup in all of these things? But now we're looking to see, is it leveling off? Is it coming down? We are also going to see the GDP report, as I mentioned, and we're going to have consumer confidence reports. We saw consumer confidence actually ticking up. But what we want to see on Friday is consumer confidence also, in terms of looking at future inflation, is that starting to come down and level off? We saw a slight uptick. We don't want to see that, because the one thing the Federal Reserve doesn't want, nor does any central bank want, is that consumers see inflation as entrenched. In other words, we're getting used to it, and we just figure, hey, we just got to pay these higher prices. This is extremely important. And then again, on Friday, the all-important PPI report. And, you'll hear a lot of talk about it this week. Now, also this week, in terms of earnings, everyone knows why this week is important. We have a broad spectrum of earnings, meaning so many sectors. However, Big tech is reporting this week. And what we want to hear is, how are things going? What are your customers doing? What are your customers saying? And also, we want to see what their operating margins look like. Keep in mind that when Tesla reported, you saw the share price come down. The operating margins were pressured, not overwhelmingly dramatically, but enough for the market to say, whoa, this is not what we expected. This is not what we want. Although the market did expect to see operating margins come down a bit, but not to the extent that they did. This is what we are looking for when we hear from Microsoft, when we hear from Google, Alphabet, when we hear from Meta, and the others. And it will be, give us a sense of what, again, where you are headed, what your customers think. I go back to, by the way, last year, when we heard from Microsoft. And when Microsoft's earnings came out in the fourth quarter, actually, the initial reaction in the futures market was higher. It was higher. But then the CFO mentioned that the consumer, their customers would tell, not necessarily retail consumers, but their clients were saying, we're holding off. We're holding off on buying. We're not sure what the conditions are going to be, what the economic backdrop is going to be. And that's when the share price came down. Now, again, overall, what we want is an overall picture from big tech, because big tech has been very popular for investors in this ongoing battle between price action. That's what we call it, price action. What is the market telling us? The market is telling us that, despite some sell-off at the margin, that things are okay, versus what many of the strategists and economists are saying. Well, hey, be careful. We're headed towards a recession. There's no doubt about it. This is a tug of war. But what I always believe in, I'm going to let the companies tell me what they're seeing. What are they seeing? Remember, they're looking ahead, and the market's job is to look ahead too. But right now, price action is winning. That is to say that what we looked at over the last number of sessions tells us that the market is basically saying, no, we don't see a recession. We don't see this. We don't see that. No, all that bad news. No. We're looking ahead, and we see maybe they see the Fed finishing on early May with one rate hike, one and done. Maybe the market sees the Fed basically cutting rates before you know it and saying, all looks good. Maybe that's what the price action is saying. This week, most likely, we are going to have a more in-depth view of what companies are seeing, given all the sectors that are reporting, the vast number of companies reporting, and also, of course, big tech. So there's a lot for this market to digest this week, and it will end on Friday with the all-important producer price personal consumptions expenditures index, the PCE. A lot for the market to digest, and it will be a very important week, I believe, for the market and the market's focus on whether or not we should be looking cyclically, or should we be looking, with the staples, the defensives. This is the tug of war. That's been the seesaw trade. It could go on for some time, but something typically comes along that actually directs the market, directs the attention of the market, and shapes the thinking in terms of allocation. So, in addition, we will be very much focused on Treasury reports, on taxes coming in, and obviously the effect that all has on, yes, you've got it right if you're thinking that, the debt ceiling debate. Yes. So we'll be back next week. Thank you very much for listening. I appreciate it.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of the LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.